Hello and welcome back to The Road to Financial Freedom, a podcast that allows experts to share their stories and secrets to unlocking their financial independence. This podcast is brought to you by CamaPlan, a self-directed IRA administrator in Ambler, Pennsylvania, that is focused on educating investors with different ways to grow their retirement savings faster through alternative investments. And today, again, we are recording this podcast episode remotely. I'm Jess Jones. I'm a CamaPlan team member and your podcast host. This week, we're taking another pit stop along the road to financial freedom to focus on the topic of valuations. Learning how to make investments in alternative assets is an educational journey that many investors embark on. But when it comes to valuing those assets at the end of the year, many of us get stuck. How do you determine what the assets in your IRA are worth, especially assets that are considered as hard to value? How do you ensure that you're getting correct and acceptable valuations from credible sources? If valuations are not done properly, what are the effects it can have on your IRA? Which brings us to the introduction of today's guest, CamaPlan's own Sean Jensen. Sean is CamaPlan's compliance officer and a newly certified CPA. Over the years, he has assisted clients with their fair market valuation processes to help them put a number on those hard-to-value assets at the end of each year. On this episode, he'll sit down with me and break down some of the frequently asked questions surrounding the valuation process, as well as ways to ensure that your valuations are done correctly. So thanks for joining us this morning, Sean.
I'm glad to be here.
What have you been eating in the car? Because Sean loves to bring in very odd dishes, including little cans of anchovies that he'd sit and eat at his desk. And it's oddly one of the things I have missed most in this time of being remote.
Yeah, in particular with the anchovies, I would not just have them, but I would display them kind of proudly in my little section of the office. And they've been stolen more than once or twice.
Yeah, it's a lot of fun. We have a good time with it.
Yeah.
Well, it's good to hear from you.
I have been eating mostly homemade pasta, Miss Jones. So as a result of that, I have been eating quite well and quite frugally.
I'll send you my address after this and you can just drop some of that off if you're feeling up to it, if you're feeling particularly excited about the pasta that you're making.
Absolutely.
Today. Oh, thank you. So I'm excited to talk about this because honestly, it's something that comes up every year. And I think that people have a lot of difficulty with just, I think, understanding or wrapping their heads around the process of fair market valuations or getting valuations for these assets, especially just based on the experience that I've seen with people with IRAs. But there's actually so much more to it. So, I mean, if you can just break down, just to begin for everybody listening who might not even know what exactly a valuation is, what is it? What's a fair market valuation or just a valuation? And what does it get used for?
Certainly. The biggest issue that I tend to find with most people is that they are very in the dark on fair market values. And it's really a very simple concept. The problem being that it is just what somebody would be willing to buy this asset for today in a situation where there is no compulsion to buy, where someone doesn't have a gun to their head, if you will. So if you have two people in a kind of mythical purchase scenario, and they decide to come to terms.
Scenario, I love it. I'm going to say that forever.
Exactly. If they come to terms with each other, that is the fair market value at that point in time. And the concept does not go away despite the fact that the purchase took place, yesterday or a year ago or 10 years ago or 100 years ago. There's always a value to an asset. And initially, it is determined based off of the first value of the transaction price. But after a certain amount of time, there needs to be a relooking into the value of the asset with due time. And if we use just a simple concept of a house, you buy a house. Today, it's got the value of what you agreed to buy this house for, as is fair market value. But in 1 year's time, 2 years' time, 10 years' time, that house is most likely going to appreciate in value. And the fair market value is what your real estate broker would try to entice you to sell it at. They would be letting you know, by the way, you might be able to get this amount of money if you were to decide to put your house back up on the market. But if you also had to put it on, say, your balance sheet, if you had to tell someone else what the value of your house is at this moment in time, that's the number you're going to use, a fair market valuation. So the main purpose of valuations is giving someone else who is an outsider an insight into the importance, usefulness, and utility of your house. So a house by the beach is going to be much more valuable than a house in the middle of nowhere, showing you the idea of importance of the house, the location of the house. And then it's also a matter of, is the house itself retaining its value? Is it increasing its value based off of it holding up with time?
Got it. So like, that's actually really interesting because I haven't thought of it that way in terms of, okay, well, it can really be dependent on things like location or wear and tear over time. So like the Jersey Shore house, they destroyed that thing over the course of whatever it was, 5-6 seasons.
You seem to know one of my guilty pleasures.
Exactly.
Very nice.
What, like, that's just one random thing I remember. I was like, oh, you love this TV show. But I was just thinking of it because that makes a lot of sense. Like the idea of, I mean, obviously it was a celebrity. It became like an iconic house. So I'm sure that the value didn't decrease. But if that was just a regular house that was owned by a landlord and their tenants absolutely destroyed the place, like, does that affect the fair market value? Do you know that?
Absolutely.
Yeah.
One of my favorite things about the Jersey Shore house is that the toilet got broken about 3 seasons in a row.
Right.
And something so simple would absolutely destroy the value of the house. If you were to go into the purchase and you're like, oh, I love it. It's right off of the beach. It's very close to the boardwalk. It's right by a line of all of the shops, the iconic shops kind of in Jersey that we all know and love. You'd be like, this house needs to be worth quite a bit. Mm-hmm. Much more than the actual house itself would typically generate.
Right.
But if you took one look inside and your first instinct is that automatic, what's that? Then yes, that definitely can result in the value of the house going down. But if it's something so simple as the toilet, as long as the toilet gets fixed, it probably won't affect the overall value of the house. If it is something like the walls are compromised, the overall aesthetic of the house has somehow been altered in a way that cannot be reversed and not for the better, then that's a problem.
Right.
And that's the beauty of fair market valuations. Fair market valuations are honestly too difficult to really describe, and they're simple at the same time. And the difficulty is that it's in the eye of the beholder. So somebody is taking a look at your house like a piece of artwork, and they are determining the utility of the house. But at the same point in time, there's also that artistic quality of, there's something I like about this, or there's something I don't like about this. And that all kind of has to be incorporated into the overall valuation.
Got it. Okay. So it's way more subjectivity than I think I've ever given it credit for. So that's really interesting.
Absolutely.
Yeah. Thanks for sharing that. So you've talked about this in when I've asked you, like, okay, well, what's a fair market valuation? You talked about this in the context of the 2008 housing crisis and specifically the movie Big Short. I think that for our listeners, it would probably, I mean, I don't know if anybody else just took away the scene with just Margot Robbie in the bathtub and, or just like Ryan Gosling's, getting lost in Ryan Gosling's eyes like I did. But the fact that, that movie actually had a lot to say about valuations. And I think like if you can break it down for our listeners in a way that covers the 2008 housing crisis and how it had to do with valuations and based on everything you're saying in terms of the subjectivity or how the market can affect valuations the way that it did back in 2008.
Absolutely. One of the things before I delve into that I must say, it is kind of sad to say this, but I honestly forget that Ryan Gosling was in The Big Short.
It's a stacked cast.
It is a stacked cast, and honestly, he got outshined. Dare I say it? However, what I will say, I absolutely love The Big Short. And the reason why I love The Big Short is that it shows valuations in multiple directions. And it also shows the idea that valuations take place at a given time. So you can have a value today that is one thing and tomorrow it's something else, or literally in the snap of a finger, it can be something else. Mm-hmm. And The Big Short really helps to kind of illustrate that point. The big thing about the financial crisis is that we all think of it as the housing crisis. And yes, there was definitely a housing element that took place. But honestly, the biggest problem that took place with the economy was more securities at that time. And it was the fact that these securities were derivatives. And derivatives is just a fancy way of saying that the security itself gets its value from something else outside of that security. So in particular, the housing crisis was this idea that people were, especially large corporations, large banks, were lending money to people who had no capability to pay back their loans. And when I say no capability, I mean these people could barely pay their credit card bills at the time, and they're getting approved for houses. Mm-hmm. And these houses could be 4 times the size of something I would be able to get a loan for today. And as a result of them being put in these situations where they were kind of subject to predatory loans and not really understanding the consequences, they were able to live, we'll say, a year or so before they had to make a payment. But all of a sudden, there would be one day when all of these payments were due. And the housing market had a specific time when they first started implementing these loans, with a specific date that they were saying these loans are going to start becoming due at some time in the future, but it was a set date. And The Big Short was illustrating the key point that there were so many people who were going to default at a set date in time. And that was going to start the panic. And that's the key factor that someone like Christian Bale in that movie and his character, based off of a real hedge fund manager, was looking at. He was seeing the fact that there was going to be a set date and time, that there was going to be a default, and not just a small default, but a mass default. The actual valuations and why that matters is illustrated later on in the movie with the scene where I believe I want to say it was Selena Gomez, maybe? They had another one of those interesting celebrity cameos, and it was in a casino. And the main truth that had just been revealed that is now being explained through a casino is the idea that there were originally these packaged derivatives. And these derivatives, these securities, these just ultimately, why don't we just call them stocks? Because that's the way they would be marketed on Wall Street. Were based off of taking not one mortgage, but a whole bundle of mortgages. It could be 100 total mortgages, putting them into one tiny package. And the idea is several of these mortgages are going to get paid back. Several of these are good mortgages. But a large portion of these, probably the majority of these, are not worth the paper that they're printed on. And we're going to put them all together. And by them having a larger volume, we're going to be able to tell the population some of these have to work, right? And that's ultimately the way they were packaged. And the vast majority of them would most likely end up yielding no profits and most likely loss. The ones that would pay back probably would only pay back what's expected. So it's not like you would have any shooting stars in that package. But by bundling them, they were able to convince people that they were safe. And that safety is the key problem. It's the value of what you are marketing to the population versus what they actually intrinsically are worth. An intrinsic value is what a piece of property or an investment can deliver, and the fair market value is what someone would pay for it. So if the intrinsic value is significantly below fair value, there's a problem there. That disconnect can result in large problems. And in that scene in The Big Short, they were saying it's not just the fact that we have these stocks and that their value might be a little skewed. The bigger problem is these stocks have underlying stocks that are attached to them. And so the bank itself might be marketing one stock, but the actual population is buying a number of what they called side bets. And they used the illustration of gambling in a casino. And I believe they were shooting craps, if I remember correctly. And the idea is you had somebody who was rolling, and that's kind of the stock market, if you will, or the primary market. And then all of a sudden there are people who just start watching. And these people who are watching are like, that's interesting. I'll bet you something based off of the outcome of this roll of the dice. So if they were to say, okay, this person's on a hot streak, they're rolling a lot of, say, sevens. when you haven't set the line yet. Hopefully you know craps and get what I'm saying.
Sure.
So the idea is you
Keep
have
going.
to roll a number. You have to roll a number of sevens in a row if you possibly can, and 7 is the highest probability roll with 2 dice. So as a result of that, these people are now watching what is happening, and they're making bets based off of what is taking place in a separate medium with other people. But the underlying action that is taking place is what's happening at the craps table. And there could be somebody who is watching these two, and that's like, oh, that's interesting. I like what they're talking about there. How about I make a bet that he'll win his bet? And it just kind of ends up being that whisper down the line. Eventually, the actual bet is so far removed from what's taking place at the table, but it all relies on the domino effect of what's taking place on that table. And if you're marketing these securities as safe, if these securities are being marketed to the population as you can't miss, then everybody is going to that table and they're viewing this table and seeing this gambling as it's not gambling, it's a sure thing. And that's a fundamental disconnect that took place between what is actual intrinsic value and fair market value. When you have that big of a gap, that's when you have that term that they love to throw around of a bubble. That bubble is the idea that we believe that this house is worth $1 million. Whereas yesterday, in a blink of an eye, it went from $300,000 to $1 million.
Right.
And it only went to $1 million because people have money and are willing to spend. And so because there is that supply-demand factor, they have turned this house into a $1 million house by perception alone.
God. Okay. Well, you know what? I have to go back and rewatch that movie because now I think I could, now knowing that, I think I would see that scene with a lot of different perspective. I also forgot Selena Gomez was in it. So again, example, stacked cast.
Was I correct on Selena Gomez?
No, I definitely think you're right. I think it was her. I just, was so busy being lost in Gosling's eyes, I forgot. But I didn't understand the idea of intrinsic versus fair market until you kind of just laid all of that out. The idea that there are a bunch of different values and the fair market value is what and correct me if I'm wrong, what you're trying to sell it for or purchase it for, or what you would want people to purchase it for?
Sure, absolutely, yes.
Yeah,
if you own a house and you want to sell this house, you want to move someplace else, you just want the cash, maybe you have multiple houses and are just trying to liquidate an asset. The fair market value is what somebody would be willing to pay for this, but it is subject to a number of constraints. The first and most important constraint is fair market value is ultimately the most optimistic price you can get. Mm-hmm. That does not mean it's the price you will get. So if you say have 10 houses, but you're also in financial dire straits and you need cash right now, in terms of you walking into the marketplace and demanding a set amount of money, you are going to most likely be unsuccessful. Rather, you have to put it into the market at a suggested price. And somebody's going to come back to you and say, I don't necessarily want to pay that, but are you willing to accept $10,000 below your asking price? And you're going to end up at an agreed upon price, or you're not going to sell it. And if you don't sell it, the actual incident of you not being able to sell it at the price you want, in and of itself kind of reduces the fair market value. Because the way that most fair market values are generated is not necessarily by you selling your house. Fair market values are typically generated by a financial expert, someone who knows what they're looking at, taking a look at your house and the circumstances. And if you were to try and sell your house today and you fail, and you had, maybe we say value your house today at $350,000, and you were short of cash and you wanted to sell it today at $300,000 to entice somebody to take you up in the offer of buying your house immediately, and you had no buyers, then if somebody who is an expert is looking at you selling the house in that situation and says, you just tried to sell it for $300,000 and you failed, they might be like, maybe it's worth $285,000. Maybe it's worth $250,000. Now, if you say, that's ridiculous, I don't want to accept $250,000, that's less than what I paid for this house, then you could, at the same point in time, take it off the marketplace today, and you could sell it maybe in the summer when all of those young couples that just got married are looking for houses or whatever the case may be. And you might be able to sell it for $400,000. So fair market value is a moving target.
Right.
It is never
Okay.
set in stone. And that's kind of why it's different from intrinsic value. That kind of throwing the dart at a target that is constantly moving is kind of what's happening. So if you can at any point in time lock in a price, that is technically fair market value. But is it really the fair market value of the house, or is it a steal? Is it a bargain? And is the bargain taken into account? Absolutely, it's taken into account. But the intrinsic value is completely separate, because the intrinsic value is like, this house can deliver something. There is something about this house that will never go away, or as long as it's kept in good order, will not go away. So if this house gets sold below market because you are just compulsed by yourself and not compulsed by the buyer, then the house itself still holds its intrinsic value, and literally just holding the house for, say, 6 months can increase its fair market value $150,000 in that scenario, from, say, $250 back to the $400 that it would ultimately be sold for. So if I sold to you at $250 because I was compulsed to sell because I just needed cash, and I end up generating $250,000 cash today based off of that sale, you can then say, I think I made a steal on this. And you can hold that house for literally 1 day, list it on the market the very next day, and sell it for $400,000.
Wow.
Now, you would, of course, in that situation, be paying ordinary income instead of capital gains, because of the fact that you would be, instead of holding it for 1 year and making it a capital gain as an investment, you would be turning around, selling it, and it would be considered a short-term capital gain, which is ultimately taxed at ordinary tax rates. So it would be against your best wishes to do that. But that is something that absolutely can happen. There are definitely scenarios where somebody gets a steal and they instantaneously are like, I can flip this tomorrow.
Wow. I honestly didn't realize just how much of a moving target it was and just how subjective it can be. So I think that that's really interesting. And I think it's helpful for, at least if, if someone's listening and they've got a brand new investment, or they're thinking, how am I going to sell this house that I've had, or whatever. The idea of sometimes just not knowing enough or not being educated enough can really make a difference on making or losing that much money. It's kind of astounding.
Certainly. In fact, if I can interject really quickly, this is not even necessarily pertaining to fair market valuations. It's just something I read that I find absolutely fascinating. Mm-hmm. And it's the idea of listening to experts. And it kind of delves into this concept, and it's specifically helpful, I think, for people who do have real estate, and CamaPlan has plenty of real estate clients. If you have a piece of real estate and you look to sell it, the issue is that you don't necessarily have the basis, the knowledge to sell your house. Several people might, but not everyone does. And I would say it's probably the majority of people who do not have the knowledge. Mm-hmm. And you would go to a real estate agent, you would ask them to list your house. Well, the problem here is that the real estate agent is an expert, but he or she is not necessarily an expert for you. They're an expert just in general. And they also work on commission. So it makes sense for them to churn houses as opposed for them to hold a house for a long period of time and then only sell it when the right deal comes across. And so because they get commission, let's think about this in terms, and really the book Freakonomics, I think, was the example that I remember this from. But the idea of you trying to sell your house for an extra 10 grand, if you're trying to sell your house and you want to hold out for your number and this person lowballs you by $10,000, well, that $10,000 to you makes a big difference, because after commission, you'll probably get $9,000, maybe $9,500 of that 10 grand. But the people who are trying to sell the house for you, they only get a small piece of that pie. And doesn't make a lot of sense to them to sell it today for an extra sell it a month from now for an extra $200? Or does it make more sense for them to sell it today short of the $200, but then move on to the next house?
Got it. Yeah. So there's like the idea that there should be a specific type of person or a specific qualified person to perform these valuations is so integral to the idea of doing this correctly. I'm just wondering if you can elaborate some more, and I think you mentioned this before, but elaborate some more on the idea of like who should perform a valuation for your assets, whether it's in your IRA or just elsewhere if you just own property. What necessarily qualifies somebody and who are the best people to look out for?
Certainly. If you're dealing with high-level valuations at, say, like a corporation, especially one that is listed on the SEC, then you might need significantly stricter and more qualified individuals and perhaps institutions than what I'm about to advocate. But in terms of IRAs and the type of assets that would most likely be in someone's IRA, we at CamaPlan require typically somebody who is either a CPA, a lawyer, an appraiser, or somebody who has got significant experience, and typically with someone who's got significant experience as a valuation expert, if you will. We would kind of like to see some of their work, maybe an example, or better yet, and this I think should absolutely be something people look to do if they have the opportunity, they should provide a valuation report. So not necessarily just a full note saying, hi, my name is this, I am this level professional, and I certify that this property is worth X dollars. Rather, give me a full report, because if I look at the report, I can take a look at the fundamentals that you're using that underlie the value that you provide.
Right. It's like on a math test where they're like, show your work.
Absolutely.
Yeah.
Absolutely. They're giving me a worksheet that I am following, and that worksheet is telling me how they came to their conclusion. Mm-hmm. And that's key. It's absolutely key. And the reason being that if I'm going to take a look at it and say your house right now on our books is listed at $300,000, if you provide me a fair market valuation and say that this house is worth $100,000, I'm going to pause. If you provide it to me and say it's worth $1 million, I'm going to pause. If it's just a very large change, what we in the accounting profession would call a material change, and if I can just interject the definition of materiality really quickly, and honestly, you will never need this word, and it's almost useless to any of you who are non-accountants, but the actual term is very useful. Materiality is based off of the concept of financial statements of a company, especially if they were listed on the stock exchange. And the idea is if there was a misstatement on this financial statement of X amount of dollars, would that cause somebody with limited knowledge of financial statements to change their mind about the company? And so in the context of evaluation, materiality would be if there is a change in value that would make me pause, then I almost am honor bound by my CPA profession, my license, to take a look at it and be like, why? And one of the things that we do all the time here at CamaPlan is we'll take a look and have just automatically the eye test. Instantaneously, do I pause when I look at it? If it went up 10%, I mean, that makes a ton of sense that investments hopefully are going up 10%, hopefully more than 10%. But if it went up 200% in 2 months, why? What am I missing? What's the information that's not being supplied? So materiality is the key. It is the kind of the underlying concept that really defines the accounting profession. What would someone else think with no knowledge of this situation if they were to take a look at that? And I kind of apply materiality from the context of the IRS. What would the IRS think if this person has put a bunch of money into a traditional account and not paid taxes, and they're right now at this moment in time saying they want to convert this property to a Roth, pay the taxes now, and if in, say, 2 months' time, this property is now worth 10 times the value, magically. So we need to have our due diligence at the time that the valuation is provided to say, does this make sense? Do we have enough supporting documentation for us to be okay with allowing this? Or is this person trying to pull a fast one on us? Do they know right now that it's worth 10 times the value?
Right. So it's a lot of instinct trusting, but also credibility building and understanding that a person's reputation can be staked on the fact that they're showing their work. They're providing real examples versus someone else. You kind of have to, do I trust this person? Does it seem kind of, again, it's a lot of subjectivity.
Absolutely.
Yeah.
It is 100% subjectivity. That's why the credentials are very useful. If someone is a CPA and they practice as a CPA, they are not necessarily just somebody who is a person who holds the license working as, say, like a manager in a company, but rather they are a practicing CPA. They see people's assets on a regular basis. Like, think about the person who's doing your taxes on a regular basis. If they're providing values to the IRS, like, they have to then in and of themselves be either making valuations or finding someone else to do the valuations.
Right.
The estate tax, which gets labeled by the right, the death tax, as a way of kind of inducing fear. The estate tax is a tax that will not touch 99% of the population. The estate tax is quite simply a tax upon someone's death whose estate in total is worth more than, I think it's been raised up to like close to $10 million. And it's total net value based off of valuations, not based off of the total amount of disposable cash you have in the bank. When I first studied, and I mean, I don't deal with the estate tax right now, I just remember the concept when I studied, the exclusion was about $6 million. It has now been raised to, I believe, around $10 million, but I would have to check up on that. But the concept itself is that there is a total value that they say, once you eclipse this value, you have to pay a tax directly to the United States government. So literally a tax upon death that the heirs of an estate would have to pay. And there is an exclusion with the wife of, or the spouse, I should say, of the person who died. So if they are married, and no, this does not have to be someone they have been married to for 30 years. They could be married to someone for 30 years, and then that person could pass away, and then they get married tomorrow, and then that person gets the exclusion as a married person. But if they have a spouse, you are able to double the exclusion. So typically it would be double the amount. So if it's 10 million, it would be 20 million. And ultimately that excludes, we'll say 99% of the population. But the idea is, if you're Bill Gates, the second that Bill Gates passes away, the whole entire estate theoretically should pass to the spouse.
Right.
If the spouse passes away and then Bill Gates passes away, or Bill Gates passes away and then the spouse passes away, all of a sudden that triggers the event of estate tax. And that means that every single asset that is owned by Bill Gates is valued at that moment in time. And they probably have about 6 months or so to complete this whole request. And they'll take the entire value of his estate, and it does not matter if it is liquid. It does not matter if this asset can be sold. So say Microsoft as a company, if you will. Can it instantaneously be sold within 6 months? No, not necessarily. But they value all of the assets of this person's estate, and then they say, you now owe a tax of, I believe it's about 35-40%. So the way that it was described to me when I was in Villanova University studying accounting was Tommy Boy. The idea that Tommy Boy's father just gets married to Bo Derek, who is, okay, she's essentially a trophy wife. How much does he really love her is the main question. And she also has the evil stepson, and the evil stepson also is ultimately, spoiler alert, ultimately is her husband. And they were trying to pull a fast one. Well, the issue here is that Tommy Boy, his father dies, and the entirety of the company either passes to Tommy Boy as his heir if he so chooses, but the second it passes to Tommy Boy, it would trigger estate tax. or it passes to the evil wife attached to the evil stepson. And in that situation, there would be no tax. So the question being, which one would the father rather want? Well, the father would rather want it in Tommy Boy's hands, but the company was failing. It was, we'll value it at, say, $20 million. And, large auto part, selling brake pads, like $20 million is not out of the realm of possibility. And it's worth $20 million, and the father has next to nothing else to his name. So Tommy Boy might get a house, he might get a few cars, he might get a few nice objects, but ultimately he's probably outside of the house getting less than $500,000 worth of assets. So Tommy Boy the next day would have to pay taxes on what is above the exclusion. And at the time, this $20 million house, the exclusion was, say, $5-6 million. So he would then have $15 million above the tax, and he would have to pay 40% on what was above the tax, which means he would need to pay $6 million, we'll say. And that business is not liquid. He can't just sell it. And that $20 million, he might sell it for 15.
Right.
So the idea of its value is separate from what you can actually salvage. And I think that's one of the key concepts of fair market values, is it's really a number of things. I mean, I'm sorry to continue adding just more and more different examples, but I think each one of them provides a little context.
Right. So like sales, like going to a store, seeing a shirt you really like, it's $60 for a t-shirt, but you wait till the end of the summer and that t-shirt's now marked down to 40%, like end of the summer sale, this and that. And that t-shirt, you're going to get it for 40% of that original value because you held out.
Well, how about I one-up you, Miss Jones?
Oh, jeez.
How about a global pandemic happens and every single company in the world decides to do fire sales to try and make back the money that they're losing? Mm-hmm. So we are living in an interesting time, and this interesting time is showing us a market that is rapidly changing, and honestly, no one has a clue.
Right.
And that's kind of the beauty of all of this, is that there's a beauty in finding an equilibrium, even if it is disturbing while you are kind of oscillating back and forth. But when you find that equilibrium, you kind of sort of reach an understanding, and at the end of that, you're like, okay, I get that. What's interesting right now is we are still short of an equilibrium, and we are in that kind of I don't know phase. How many assets are being devalued as we speak? How many assets were plummeted in value, say in March, April? Mm-hmm. And are these assets coming back? I mean, there are a ton of stocks in the stock market that completely went down 60, 70, 80% in value that have only risen 10, 20%. And I'll use a specific stock that I'm familiar with, Dave & Buster's. Like, how can you go to a Dave & Buster's in a global pandemic, especially when this first started?
Right. That is ground zero for pandemic. Exactly. Dave & Buster's, yeah.
Well, their stock, I believe, was trading above $60. Right. So the fair market value for one stock in their company was over $60. I believe it is sub 20 still. I don't believe that it has eclipsed $20. And that is probably less than 30% value of the stock. Will it go back? It depends. It depends on, number one, can they survive this? So in terms of accounting, when somebody's looking at like an external auditor is looking at the financial statements of a company, they have what they call a going concern. And a going concern is a disclaimer, and it's a beacon that is being signaled to the people who will rely on those financial statements. And it is the accountant stating that I am not certain that this business will be able to handle what it's currently handling. They're saying, like, they're presenting things to me, and they're also giving me their elevator pitch as to why this is not a problem. But what they are not doing is alleviating my fear that this company might not be able to continue operating this way.
Right.
So as an external auditor, it is my duty to tell you I'm concerned.
Right.
Now, I'll present the data I'm just letting you know that I am concerned and that this company, we are operating with the agreed upon knowledge that this is a concern. It should be a concern for you. So read the data carefully, that when you're investing, it is your due diligence that matters. We are letting you know, do it at this moment in time.
Yeah, I think that's that makes a lot of sense, especially the idea of like there's so much that's changing even now within this 6 to 8, I don't know how many months it's been at this point, of constant change and constant unknown. That idea of like check on your investments and see what's happening, especially because the end of the year is quickly approaching. I don't know how things are different in terms of these assets that are considered hard to value and how fair market values work in IRAs. Did you want to touch some more about just like the alternative assets versus valuing traditional assets? How are they different? What makes something hard to value? And how does all this work in somebody's IRA?
Well, absolutely. But if I can take a quick sidebar.
Detour away, my friend.
this is kind of pertaining to your question perfectly. But at the same point in time is, once again, it's COVID. It's the idea of a changing, evolving marketplace. The idea is, say you have a secured note, as well as, I mean, you could also have a renter, right? That secured note is based off of a house. Is that house worth what that house used to be worth? And more importantly, that note, say, instead of it being secured by a house, maybe it's secured by a business. Is that business worth what it used to be worth? And more importantly, that business, when COVID happened, are they able to meet their obligations? One of the key things that a lot of businesses have to deal with is that they get large-scale loans from banks, much larger than we can get personally. And these large-scale loans, they usually have what are called debt covenants. And these debt covenants are stipulations that the bank has for what the business has to do to maintain itself in good standing with the bank. They might have debt to equity ratios that need to be maintained, meaning essentially you can't just find another bank and run up debt indefinitely and eventually have 10 times more debt than you actually have value or equity in this business. But it also can be, you need to keep a certain amount of cash on hand. It can be that your overall business value can't drop below. Like ultimately they can add just whatever they want. They could say ultimately on a contract that you need to eat a bagel every morning. And if you don't decide to eat a bagel a certain day, you're in breach of contract. That's the beauty of contracts. You can literally say whatever you want.
Yeah.
As long as it's agreed upon by both sides, then you have to adhere to it as long as it's not illegal. But most of these debt covenants, how are they being impacted by COVID is a fascinating concept to me. I feel like when things are chaos, us accountants are just kind of thinking, just one of those staring out the windows, not really focusing on anything, just thinking. And in COVID right now, one of my main questions is all of those loans, right? Say secured or unsecured loans, those instantaneously are impacted, right? I mean, one of the positives of valuations, because most people who I deal with who we tell need a valuation, they scoff at the fact they're like, whoa, I need to pay money for this. And how much is it going to cost? Wait, they're going to charge me what for this? The reason for evaluation, the intrinsic value of evaluation is that if you have the right asset and the right time, which is the most important concept, if you at the right time decide to get a valuation done, you can take your asset that say today is worth $100,000. Tomorrow it can be worth $20,000. And you might still be paid back $100,000 plus interest. But uncertainty means that someone looking at it is like, I don't know, I'd put 20 cents on the dollar for that. And you could then say, okay, I'll take that and I'll do a Roth conversion based off of that. Why don't I put this into a Roth account at 20 cents on the dollar because COVID, and it's now in my Roth and I am talking to the guy and he's telling me that, no, I think I should be able to handle this, but there's just the uncertainty. Like, honestly, things are a bit difficult, but as long as you work with me, I'll be able to pay you back. That could be enough, for you to convert it, get paid back at $100,000, but pay taxes on 20. And this is precisely the reason why we want the valuation report. We want something with backbone to it, because we are fine with converting it at $20,000 as long as there's enough for us to say, like, they understand what they did. We need to know this valuator understands. And hopefully the valuator did his own due diligence. It's not necessarily going to come back on CamaPlan if the valuator did not do his own due diligence. It would go on the valuator. The person you would have to sue would not necessarily be CamaPlan, because we just processed what you gave us. The valuator would have to substantiate why they valued it at that value. But we want the valuation report so that we can say, they valued it at this value, we have their signature, and here is the attestation report that is giving us the reason why.
Got it. Okay. So then I guess hard to value would be like kind of like you're saying, the idea of, okay, so it's a note, there are conditions within a contract. That's just become even harder to value than a tangible physical asset like the real estate itself.
Certainly.
Because there's so much up in the air.
How about we use an even better example for hard to value? There was a craze, I don't know if you heard about it, called Bitcoin and cryptocurrencies.
Oh, yes. Can't say I got into it, but I've heard of it.
Absolutely. So the beauty of cryptocurrencies is that it's an alternative way of doing things. It makes sense. It's Orwellian. It's a little scary, but at the same point in time, it also makes perfect sense. But the thing about cryptocurrencies is that because it's a new medium, it has difficulties that you might not have thought about, difficulties you might not have seen. And one of the key difficulties being, how do you extract this and turn this into actual cash? So if I were to put my life savings into Bitcoin, can I tomorrow get back every single dollar in cash? And if you can't, and more importantly, because it's electronic, like if you lose your access somehow, someone hacks it, it just could disappear. Like theoretically speaking, the same thing can happen at a bank, but I'm much more confident that the bank is going to actually keep track of my money. So this idea of I've got $100,000 that I invested in a Bitcoin, the second you invested it in a Bitcoin, my first thought would be it's worth 20 cents on the dollar. Like I would instantaneously devalue your asset, because my main question would be, what's the chances of you getting this back?
Right. There's a lot of margin for error that you're accounting for too.
Exactly. Yeah. So all of those people who rode that one wave where Bitcoin went from, say, $300 for a coin, or $3,000 for a coin. I mean, I'm probably sounding completely and utterly ignorant of this, but it was like $3,000 for a coin, and then all of a sudden it was $20,000 for a coin almost within a few days.
I don't necessarily think that that's ignorant. I think it is the idea. It kind of enforces the definition of hard to value. It does create the idea of like, okay, you're investing in something that not many people are going to know about or understand the complete ins and outs of. So you're subjecting yourself to a certain amount of potential error and potential false valuation here.
Exactly.
Yeah.
One of the key problems here, the valuation, and it kind of segues into why you need a valuation when you need a valuation. But anytime there is a taxable event that takes place from your account, that means even without liquidation. So if you distributed the asset, you're saying, okay, it's in my traditional, now I want to take it personally. When you do that, that triggers tax. Even if we don't give you cash, it's what accountants would call phantom income. Phantom income is you receive income even though you did not receive cash. So if I were to distribute your asset and all you have is an unsecured note, then we're just giving you the unsecured note and you have to pay taxes on it, even though we didn't give you the cash to cover those taxes. So anytime there is a taxable event, distributions, Roth conversions, which I already specified, but RMDs are one of the key ones. Whenever there is a taxable event, the taxable amount is based off of the fair market value of what is being taxed. In the case of an RMD, it's the total value of your account. What is the fair market value at this moment in time? Now, that's not a problem if we're, say, dealing with a stock portfolio, because at every moment in time, there is an underlying fair market value of every stock in there every second. So you know what the value of that stock is. In fact, there is a fair market value after the market is closed. And I mean, it's magic to me. It's hoodoo, it's wizardry. But there continues to be trading despite the fact that the stock market closes.
Right.
Amongst the United States. Like, it's not just that people in other stock indices are trading. It's the fact that the brokers, for some reason, have more rights than the average person. Mm-hmm. But there is always a fair market value when it comes to stock. There is not necessarily always a readily accessible fair market value to an unsecured note that is held in your CamaPlan account. So if you were to take an RMD, we require an FMV. We need something that values your account. Most of the time, I would say that you could probably argue most assets are worth less, with the exception of, say, real estate, precious metals, stock, unless it's really closely held stock, which is more like just actually owning part of a business than owning a tradable commodity, the way that most stocks on the free market are. With the exception of those, most of your assets you could probably argue are worth less because uncertainty. COVID is a great example of just creating more uncertainty, where it's like, okay, it's a secured note, but we don't even know that the security is going to be worth what we want, and we don't know if they're going to be able to pay. So there's just too much uncertainty. So we should probably value it at 20 cents on the dollar, even if you're confident that it's going to be paid back. So because of that, when there are taxable events, we need the fair market value, but we're not too concerned about the ones that we're like, they'll probably be worth less in due time. But if we are concerned that the value might be higher, that's a problem. And the biggest problem with RMDs is that these are people who are getting up there in age, are not necessarily even involved in their own finances anymore, and they maybe don't have their family helping them with their finances. They might just be honestly avoiding what is happening. They might have forgotten that we exist.
Right.
And believe me, it would not be the first time.
Yeah, no.
And it's sad. It's very sad. But the problem is they need to get us an FMV, and the government doesn't want to hear that they just did not.
Right. The government's not going to be as kind as, necessarily like they wouldn't be as understanding as like your IRA custodian or your personal financial advisor is going to be. Like they see you as a name and numbers and not necessarily the person and the story. Number. Yeah.
And it's unfortunate, but it is the way that things go. And what I would also say is that when I was taking some of my continuing credits for my CPA, they had different lectures that I could listen to. And what was fascinating, because it was a former IRS employee giving you the rundown on how it actually works. And I had no idea, like, the bells and whistles and what's actually taking place inside. But 99% of what they process is processed through a computer, and not a single pair of human eyes sees it until they trip an alarm that says this person's probably guilty. So when they actually look at your stuff, if they look at your stuff, and granted, it's probably a small percentage chance that they will, but if they look at you, they are looking at you through the lens of you are guilty until proven innocent.
Right.
They are not necessarily looking at you through the lens of you are innocent until proven guilty. And a lot of those people are not necessarily aware of valuations. They are not necessarily aware of why something would change in value. And, think about it, right? Somebody who's working at the IRS, that might have been someone who was just hired out of school. They might have not studied accounting. They might have studied something else, say business administration or whatever the case may be. They might be ignorant of what you are providing them.
Right.
And it's unfortunate, but at the same point in time, it's something that you can foresee, which is why do your due diligence. Absolutely, at any and all times, do your due diligence. This is done to protect you.
Right.
This is not done necessarily to protect CamaPlan. This is done to protect you. And when we kind of interject and say we don't want to do this, yes, this is us protecting CamaPlan, but we are also saying you don't want to do this.
Right.
Unless you can provide us more diligence for this, you don't want to do this for your account, because I am curious. I am skeptical of where you got this number from. And we always want to kind of also be seen as your advocate. We're not necessarily your enemy.
Yeah, exactly. Well, I appreciate all of this information. I think it's going to be really helpful for not only new listeners and new investors, but I think people who may be long-standing clients with CamaPlan who just have maybe run into roadblocks with fair market values and getting their valuations before, and just can understand this in a really much more tangible way of breaking it down, especially if they're fans of The Big Short. So thank you, Sean.
Absolutely. And if I can just really quickly have one final point. We require fair market values in the situations in which there is a taxable event. We won't do the transaction without fair market values. In the case of RMDs, it's a little different. We might try and come up with a third-party valuation ourselves, whatever the case may be in that case. But for a Roth conversion, for a distribution, you must have a fair market value. But when it comes to just year-end valuations, when we ask for FMVs at the end of the year, if you are not triggering a taxable event, we are a little more lax because it's it's almost impossible for us to truly track you all down. We want you to provide it. It's in your best interest.
Right.
But the idea is you really should be concerned when there is a taxable event that is triggered.
Got it. Okay. Well, thank you. This has definitely helped me understand it a little bit better. And I've been working at CamaPlan for a year and a half. So I think this is going to be really helpful for a lot of our listeners. If you can just quickly summarize, I guess, 3 major points of this discussion, Sean, and just kind of break it down for people who are maybe doing their fair market values for the first time this year, the 3 things they need to be aware of, or 4 things, whatever you think it needs to be. And then just lastly, how can people, reach out to you, or do you have an email address? I know you are notoriously not on social media, but whatever. Any way that people can, if they have more questions after hearing this, can they reach out to you and ask you any additional questions?
Yes, he's one of those millennials, not on social media. Certainly. So in terms of the 3 main points, if I can give you a visual to kind of explain what I started this whole entire podcast with, fair market valuations are like putting during an earthquake. The ground is moving underneath your feet, so what you think you need to do is changing as you go. And kind of underlying that, when you decide to go and get a valuation, understand you can pick 15 different valuators until you get a valuation you like. Because none of them are right and none of them are wrong. They are opinions, and as long as you have an opinion with a justification, then you can use that valuation. As long as the valuator is aware of all of the facts, you cannot be influencing the valuation, if you will. You can't be trying to, you can be trying to get the valuation you want by giving them all the facts. What you can't be doing is steering them to your valuation by deciding to cherry pick facts or this or that. So you can absolutely go to more than one valuator, especially if you're doing like a Roth conversion or a distribution of an asset. You can go to more than one and you can find someone who gives you a valuation you like. The second key point is that on top of valuations just shifting left and right and going crazy, valuations are based really on perception. So you need to see through your own lens. And I would highly encourage people to see through their own lens. Just think, what would I pay for that business? What would I pay for that car, right? Next time you go car shopping, I myself am a Honda person. So say we'll go to a Honda dealership. Right. If I'm seeing a used car, what would I pay for that car? What are they listing it at, and why are they listing it that way? Used cars are typically listed at a value based off of how old the car is, how good of shape the car is, and how many miles the car has, right? So it's intrinsic value that they're really looking at. They're like, okay, is this car modern? Is it up to date? Does it have the bells and whistles that I would expect a modern, up-to-date car to have? Number 2, this car is 2 years old. How did it get 150,000 miles on it, right? Like if in that situation, it's going to be marked down significantly despite the fact that it's a brand new car, 1 or 2 years old. But also, is the hubcap, falling off, like whatever the case may be. Third point, let's see, hard to value assets and the importance within your IRA of getting the valuations. When you have hard to value assets, it's number one, good peace of mind to just get a valuation for you to know what your asset is worth. But also, if you're looking into your finances and you're looking for something that puts you in a better spot, gets you I don't want to offer too much advice, but the idea of kind of using the right leverage, the right timing of something. If you know roughly what your asset is worth, that might impact what you decide to do in the future. Like if you knew that you could potentially take a look at your unsecured note, and even though you know who it is with and you trust they're going to pay you back, if you do a conversion right now and pay the taxes, you might be able to do the conversion at a significantly reduced rate. Same thing with, say, a private placement. If you have an investment in a company that is a small company, fairly closely held, especially if that company, you're not necessarily able to force a liquidation of your shares. So you own a percentage at that company and they would have to divest you, and they would have to have a meeting of their board of directors and have an agreed upon vote to divest you. So difficult for you to just walk up to them and say, I want my money back. Then all of those factors would aid in reducing the value of your investment, despite the fact that the company might be showing great promise.
Right.
So don't necessarily think that your asset is going to be at face value or even close to face value. It really depends on the type of asset. If it's a stock, you know what the asset of it is, unless it's closely held, in which is closer to a private placement. But if you've got a note and if you have a private placement, you can absolutely have someone take a look at that. And if they took a look at it, would they be like, I don't know, this kind of skeeves me out? And if they did say that, they might be willing to put it at 20 cents on the dollar with full facts. And you're like, I know this is going to pay back. This guy, he's a friend of mine, or this guy, I really understand his business and I know that they are getting better. They're making money. With your comfort in it and the accountant's level of uncertainty, you can profit off of that. So I would definitely say it's always good to know what someone else thinks of your asset. And is there something that you can do, you can use to your advantage as a result of that?
Great. Thank you. This is really helpful. And I think it's going to help a lot of our listeners. So if you don't feel like giving out your personal cell phone number, what's your best email address for people to reach you?
Sure. How about my social security number instead?
That sounds great. We just talked about due diligence, but give it out. Go ahead.
If someone does have a question, they can always reach me at sjensen, Jensen at CamaPlan.com. Or they could just send a general question to either sales and marketing or operations at CamaPlan.com. As those, everyone there will, if it's something that pertains to me, will get me involved, let me know that it's there.
Absolutely. Well, thank you again, Sean. Really appreciate you being here.
My pleasure.
Thanks, everyone. So tune in next week to hear more from our experts who have paved their roads to financial freedom, or call CamaPlan today to learn more about how you can start to take control of your future wealth. Have a good one, guys.